Hello and welcome everyone to today's webinar, which is part of the Young Scholars webinar series. My name is Anastasia Papas and I'm the founder and director of the Access Forum. Today we have Joanna Harris, who will present her paper, Regulating ESG Disclosures. Joanna is a fifth-year PhD candidate in the Joint Program in Financial Economics at the University of Chicago. Her primary research focus is the interaction between environmental regulation and financial markets. And prior to her PhD program, she worked in the finance division of Columbia Business School as a predoctoral research fellow and as a trader at an investment bank. She graduated from the University of Chicago in 2017 with a double major in economics and statistics. But I'm going to pass the floor first to Alisa Kleinhuis, who is moderating the webinar today.
Welcome, Joanna. We're very, very pleased to have you here today, and we much look forward to your presentation on regulating ESG disclosure. I think we have about 45 minutes of presentation, followed by a Q&A, and if you're okay with that, but you should indicate that, Joanna, if people have urgent questions in the meantime, they can maybe raise their hands, and then I can give the floor to them. Does that sound good?
Yeah, please feel free to interrupt me with questions. I'm not sure that I'll use the full 45 minutes, so I'm happy to answer questions.
Okay, well, the floor is all yours.
Thank you for having me. I'm excited to present my paper, Regulating ESG Disclosure, which is joint work with Marina and Francois. So the motivation for this project started with the fact that data providers and market participants disagree on the assessment of ESG performance. So in simple terms, that just means that there's not one definition of what it means to be green. And recent ESG disclosure regulations have come up in response to this to try to standardize the definition of greenness. For corporations, there's SEC rules on climate-related disclosures in the US, and in Europe, there's the Corporate Sustainability Reporting Directive. For intermediaries, there's bank climate stress tests and mutual fund reporting, which will be the focus of this paper. ESG disclosure regulation is controversial. For example, there was a lot of lawsuits in response to the SEC rules, which are now essentially overturned. And there's limited evidence on how ESG disclosure regulation impacts financial markets. So in this paper, we study a particular disclosure regulation, which is the European Sustainable Finance Disclosure Regulation, or SFDR. The regulation states that since March 2021, all mutual fund managers must classify their funds into one of three categories. So brown funds are Article 6, those do not promote ESG. Light green funds are Article 8, which are those that make investment decisions based on ESG characteristics. And dark green funds are Article 9, which are funds that have sustainability as a specific objective. So you can think about the typical objective of a mutual fund is some sort of risk-adjusted return or benchmark-adjusted return. These funds have a specific sustainability benchmark as well. We think that SFDR is a good setting to study disclosure rules for two main reasons. First of all, it applies uniformly to all countries in the EU, which mitigates concerns about the decision to regulate being related to specific country-level preferences, because we can observe the effect across different countries with different preferences. And through the securities holding statistics, which is an administrative data set collected by the ECB, we observe granular portfolio holdings of investors in 24 European countries. So our paper has three main parts. First, we model the effect of ESG disclosure regulation and show that there's two main channels through which this regulation transmits to portfolios. First, what we call the uncertainty channel is the direct effect, which is that investors value the lower greenness risk of investing. So when greenness becomes more certain, investors like that. The second is the greenness channel, which is that we allow funds in the model to endogenously adjust their greenness in response to the regulation, which leads them to become more green and thus leads to increased flows by the investors who value this increased greenness. The second part of our paper documents some stylized facts about the regulation. So first, we find that 55% of funds by assets under management, so that's about 4.6 trillion euros, chose one of the green categories, so either Article 8 or 9. We also find that overall green funds experience large inflows after SFDR relative to other funds. Then in our empirical section, we test the two channels of the model. So we find that consistent with the model, funds without a prior ESG rating, so you can think of those as having high uncertainty about greenness, that then chose Article 8 or 9 experience higher flows. And also funds with a low ESG rating then respond most in reducing their portfolio emissions. So they become greener, which is the greenest channel in our model, and then they experience higher flows. We also find that institutional investors respond more to SFDR. So this is sort of assessing the question of, do institutional or retail investors care more about greenness, particularly in countries with strong environmental preferences. And I'll explain what I mean by environmental preferences when I get to the data section. So to quickly place our paper in the literature, our main contribution is, or the main strand of literature that our paper relates to is the sustainable investing literature, both on the theory and empirical side. There's also a large literature about product quality more generally, and sustainability disclosure more particularly, such as Hartmark and Sussman. There's also a large literature about mutual funds and how fund managers make decisions, and more general values and market outcomes, so how social values map into market outcomes. So turning to the model, the setup is pretty standard, so I'll go through it at a high level. We have each investor I, who's choosing portfolio weights called XI in mutual funds indexed by F. As in Pastor, Stanbon, Taylor, investors value both the portfolio's return, so this is the monetary benefit that they get from holding the asset, as well as greenness, so that's the non-pecuniary benefit that they get from holding green assets. AI is their relative risk aversion, and DI is their preference for greenness. Importantly, G is the non-pecuniary benefit, so the total non-pecuniary benefit they get from holding the asset for an investor with environmental preference DI is going to be DI times G. So if they're holding a greener fund and they have strong environmental preferences, they get a larger utility benefit from that. On the fund side, mutual funds have expected returns mu-R, which in the baseline model we take to be exogenous, although we have an extension in the appendix where we endogenize it if anybody's interested, and endogenous greenness G. As in Avramov 2022, returns and greenness are both uncertain. So what that means is that investors can't perfectly observe G. And the covariance matrices are denoted sigma R and sigma G. Just for to make it easier to understand and to make it simpler, we assume that sigma RG equals 0. So what that means is that the realized return of the portfolio is not related to the realized greenness of the portfolio, conditional on the expected greenness, and that sigma R and sigma G are diagonal. So sigma R being diagonal means that returns of funds are not correlated with each other, which is obviously a very strong assumption, and we can relax this. And sigma G being diagonal just means that conditional on expected greenness, the realized greenness of a fund isn't correlated with the realized greenness of another fund. Then each fund F is going to choose its greenness GF given its target G bar. So what that means is that they're going to try to maximize profits. So their profits are the management fee eta times the assets under management, which is WF, and that's a function of G, minus a penalty term for deviating from G bar. And I'll explain in 1 second what G bar, how we interpret G bar. So the trade-off is that if they increase greenness and investors have a positive DI, so they like greenness, then their fund size is going to increase, but deviations from the target G bar are costly. And so we interpret G bar as a sort of green skill measure. What that means in practice is potentially one fund manager is an expert in, for example, wind energy. So their G bar would be higher because even if investors didn't care about greenness, they would still have a greener portfolio. Whereas another fund might be an expert in fossil fuel markets. And even if, regardless of what investors cared about, they would have a lower greenness. So it's sort of like they're unconstrained or their greenness uninfluenced by the preferences of their investors. Like what would they do if investors didn't care at all? So moving on to the equilibrium. So it's pretty straightforward, which is that the we solve for the portfolio weights of investor I, which is a function of the expected greenness and the expected returns, as well as the uncertainty about greenness and returns. So it's increasing in expected greenness. That's this DI times G, or DI over AI times G, and it's decreasing in uncertainty about greenness. So that's the sigma G inverse. All else equal, there's a higher demand for greener funds because we assume that DI is positive. And then we look at what do the funds do. So we can think of this G as, I should have said this before, in the part in the appendix when we endogenize returns, we think about G as the portfolio weight in a green asset. So if we have two assets, one brown and one green, the G is the portfolio weight in the green asset. So the greenness of the fund, or the portfolio weight allocated toward the greener asset, is going to be the greenness G bar, the baseline greenness for that fund, plus a term that's adjusted based on the preferences of the investors. So the larger investor preferences, so the sum is across investors, so it's like the wealth weighted average preference of the investors, the higher they're going to deviate from their target greenness when they're choosing their actual greenness. But the extent to which this occurs is going to depend on sigma G. So sigma G is basically going to, if it's large, going to mute the impact. So the true G is going to be closer to the G bar, because you can think about this kind of conceptually as if investors can't see the greenness because they see it with a large variance, then the funds have no incentive to tailor their portfolios to their investors' preferences because the investors can't observe it properly anyways. So the extent to which the funds deviate from their G bar or increase their greenness above their G bar is going to be related to the sigma G as well as to the environmental preferences of investors. So to illustrate this, we've kind of illustrated two cases. One is in the top panels where sigma G is high, and the second is in the bottom panels where sigma G is low. Investors' weight toward the fund is going to be higher for we have two funds, a green fund with high G bar and a brown fund with low G bar. So the weight is going to be increasing in the G bar. But when sigma G is high, that relationship is going to be relatively flat. So the high green preference investors aren't that different from the low green preference investors. Whereas in the bottom panel, when sigma G is low, there's a very steep relationship between preferences and greenness, especially for the green fund. On the fund side, we can see exactly what I showed on the previous slide, which is that the extent to which funds deviate from their G bar is going to be related to the environmental preferences of their investors. So when environmental preferences are high, you can see that the funds are going to choose greenness higher above their target greenness or their G bar. Whereas when environmental preferences are low, that gap is going to be even larger. So that slope is going to get steeper. So moving on to the role of preferences, moving on to the channels, we kind of decompose the effect of the change in sigma G into two channels. And I should say that in the model, we interpret the regulation as lowering sigma G because it's making greenness more transparent so the investors can better observe the true greenness of the funds. So we decompose this into two channels, and we call these the uncertainty channel and the greenness channel. So the uncertainty channel is this direct effect on the fund flows. So what happens when the direct effect of the investors valuing uncertainty or valuing the reduction in uncertainty. And then the second effect has to do with this partial, or the derivative of G. So how does G change when sigma G changes? And then this shows how the investors then respond to that change in G. And both of these are going to be positive when DI is positive for a fall in sigma G. So the actual derivative is negative. So then we turn to the role of environmental preferences. And we show in the paper that the magnitude of both channels is increasing in environmental preferences if some technical conditions are met, which are very reasonable. And if somebody has questions about these, I can go into them. But the idea is that investors with higher environmental preferences, so investors who care more about the environment, are more responsive to this policy change. So they move their portfolios more when sigma G falls. And the reason we look at this specific comparative static in the model is because our data and policy shock covers a broad range of countries with a broad range of environmental preferences. So the empirical prediction that comes out of this is that the two channels should be stronger in countries with stronger environmental preferences. So then to illustrate this, we illustrate the effect of the channels when sigma G is initially high and when sigma G is low. So when sigma G starts high, the uncertainty channel is going to lead to very large inflows into the fund, specifically the green fund, when sigma G falls. And then the greenish channel is going to be the same for both because it's linear, but it's going to be that the portfolio weight in the fund is going to increase because of the fund's change in greenness. And the full effect is that is going to be the sum of those two, so that the increase in portfolio weights is going to be very large for investors with very strong environmental preferences. When sigma G is low, we still have an effect, but it's much smaller because if uncertainty was low already, then investors didn't have that strong of a disutility of greenness uncertainty to begin with. So the effect is much smaller. So I think now would be a good time to take questions. I see there's some in the chat. I don't know if anybody wants to unmute themselves or. Oh, never mind. They weren't questions. But if anybody has questions, we can. You can ask them before we move on to the empirical side. Okay. So just to give a timeline of what this regulation, when this regulation occurred. So it was adopted in November 2019 and came into effect in March 2021. So funds basically were told in December 2019 that by March 2021, they had to choose one of these three categories and document what they were doing. If they were chose Article 8 or 9 specifically, they had to document how they were aligning with Article 8 or 9. Then in January 2023, level 2 came into effect, and you can basically think of that as sort of a stricter version of the regulation. So they wanted to ease funds into it, so they did it in levels. So the January 2023 version, level 2, required more detailed information. So they had to report on 18 mandatory principal adverse impact statements, and then which assess the sustainable impact of their investments. And they also had to prove that they aligned with one of the 6 environmental objectives in the taxonomy regulation, which is another sustainability regulation. Just to note, this red line is actually outdated. So our data starts in 2018 and goes all the way until 2024. So this whole thing should be red. We also take the survey data that we use to measure preferences to be before the regulation came into effect. So we don't want somehow to be polluted by the regulation coming into effect. We could do it earlier, but potentially. So our data is the securities holding statistics, which contains quarterly security level holdings for countries and sectors. So in our data, you can think of an investor as French households, German banks, Italian pension funds, etc. It covers 24 countries in the EU, and it's quarterly data from 2018 to 2024. We also take data from Morningstar. The fund categories, are they equity or bond funds, as well as the globe ratings. And we also take the SFDR information from Morningstar. So in Morningstar, we can see is that fund Article 6, 8, or 9. Then our measure of DI, so the environmental preference parameter in the model, is from the Eurobarometer survey. So like I said, we took this from a survey given in 2020, and it asks, how important is protecting the environment to you personally? There's a number of questions in the survey, but this we thought to be sort of like the most all-encompassing one of which most aligned with DI. And we just take the number of respondents that said it was important minus not important, and then divide by the number of respondents. So to give a picture of what the mutual funds market in Europe looked like before the SFDR, we had about around half of funds by assets under management, so that's 4.7 trillion euros, that had no ESG rating before SFDR. So even if you abstract away from all of these concerns of what is an ESG rating measuring, different providers disagree, et cetera, we had around half of funds that didn't have an ESG rating at all. So there was a lot of uncertainty we take this to imply that there's a lot of uncertainty about fund greenness before the SFDR. And then we had around half of funds by assets choosing Article 8 or 9. And we do see that there's a correlation between what status they choose and what their ESG rating was. So you can see that much more high globe funds, so we take that as 4 or 5 globes, chose SFDR. 8 or 9 compared to low globe funds. However, there were still a lot of funds whose ratings didn't align with their whose SFDR choice didn't align with their pre-SFDR rating. So you can see, for example, we did have a number on the left of high globe funds choosing Article 6 or low globe funds choosing Article 8 or 9. So these funds in particular are of interest to us because they were funds who Morningstar said they were brown. They had low globes, 1 or 2 globes, and they still chose to be Article 8 or 9. So now we're going to look at, over time, the assets of the different fund categories. So green funds, Article 8 and 9, grew from around 2 trillion to around 4 trillion. So this is a combination of inflows and returns. The light green funds, like you can see, account for the bulk of green funds. I think I said it was about 50%. And the assets of brown funds have remained pretty stable at around 2 trillion euros. So now we're going to look at the average globe. So this is the weighted
One question.
Yeah.
Do you think it's surprising that even in 2024 it grew again? I mean, I guess I would be wondering what the status is now with the Trump administration having come in, but do you have data all the way till Q1 of 2025?
So in principle, we should. We did a sort of data update a few months ago, so we didn't have it yet. I'm not sure. I guess it's interesting to see if because most of these funds, I guess many of the funds are going to be investing in European companies. So it's sort of how much does the Trump administration stuff affect the firms in Europe? It's definitely an interesting question. I don't have the answer because it's sort of a process to update the data.
Understood. Yeah, but I would be curious to see the impact. I mean, especially if it's, whether in some sense the EU is immune or somewhat immune from it, right?
Yeah, you could imagine the spillover kind of going either way. So it would definitely be interesting to see, like if there's sort of a pushback and the green funds get bigger, or if kind of it all goes together with the US. So yeah, that's definitely something we could look at in the future. But right now it goes to the 2024 Q3, so even before the election. So to look at the ESG ratings by fund status, so this is the average globe rating of the funds in each category. So we see that it is what we would expect. We have the brown funds have the lowest rating, and then the Article 8 or light green funds have middle, and then the dark green funds have the highest. It seems like the globe rating of green funds, in particular the Article 9, but also the Article 8, have improved over time. Just to note, there's a very large dispersion of globes within each fund category. So this is just the average, but there's a large standard deviation. So moving on to specifically, like I said, we're very interested in the funds that had 1 globe. So they were brown funds, and then they chose one of the Article 8 or 9 categories. So we wanted to know, is this pure greenwashing? Are they doing exactly the same thing? They're remaining brown, and then they're choosing Article 8 and 9 to kind of pretend to be green, or are they actually doing something to improve? So we find that the funds that had 1 globe in Article 8 and 9, so we kind of pick those funds specifically in Q4 2020. So that's why it's like fixed at 1 in Q4 2020. Then we look at the green ones versus the brown ones. So prior to the regulation, it seems like the time series variation in those 2 groups is very similar. But then after the regulation, so those funds choose Article 8 and 9, and they become greener than their peers, their 1 globe peers who didn't choose Article 8 and 9. So we're very interested in using these funds to then test the greenness channel. So these funds that used to be brown became greener after choosing Article 8 and 9, and then what do investors do in response? So now I'm going to show you some fund level evidence on flows and greenness. We have this in the stylized facts section. It's sort of a regression. So what we're doing is we're regressing the flows on a dummy for Article 8 or 9. And then we find that other than, so between 2020 Q1, so remember that the regulation was enacted in 2019, so the funds were able to start to declare their Article 8 and 9 status starting in 2019. So over the course of the regulation, it seems like those funds, the Article 8 and 9 funds, are experiencing higher flows than the Article 6 funds, specifically around the, like starting in 2020 Q1 and then going until about 2022 Q2. and then again around the enactment of level 2. And then we also want to look at the carbon intensity of these funds. So did Article 8 and 9 funds become greener? So we take the Morningstar carbon intensity. So this measures how much carbon per unit of revenue do the firms in the funds portfolio emit. And we find that it seems to drop after the regulation for Article 8 and 9 funds in particular, where the baseline here is Article 6. So now turning to the empirics, our main specification is designed to test the 2 channels in the model. So recall that the model suggests 2 channels for the impact of disclosure versus the uncertainty channel. So that's the direct impact of the information shock. So do investors value the decreased uncertainty caused by the regulation? And the second is the greenish channel. So the funds change greenness, and then investors rebalance as a result. So to study the 2 channels, we focus on 2 measures. The first is a dummy for the uncertainty shock. So that's funds with no ESG rating that chose Article 8 or 9 status. And the second is the greenish shock. So that should say funds with 1 globe in 2020 that chose Article 8 and 9 status. And then obviously we include all the other versions of it, like all the other dummies in there, but we highlight these specific groups of funds. So we look at the flow by investor I, which is investor is a country and sector, recall, to fund F and quarter T, and then we control for fund and investor characteristics. And we do this first from Q1 2021, I think that should say till Q4 2020. Oh no, it should say Q2 2022 because this is around the regulation or after the regulation. So first, this is kind of like the baseline specification. So here is the uncertainty shock. So we find that you can look at any of the columns and it seems like the uncertainty shock, so funds that had a missing globe and then chose Article 8 and 9, so they reduced their uncertainty about their greenness, had positive inflows overall. And also, even controlling for the uncertainty shock, the greenish shock still matters. So funds with 1 globe in Article 8, 1 globe in 2020, who then chose Article 8 or 9, and I showed you that those funds then became greener, they also experienced inflows after the regulation. So you can see that the uncertainty shock is about 3 times the magnitude of the greenish shock, but both of them seem to matter. One thing that's interesting to note is that the missing globe funds overall did experience inflows. And we take that to mean that because Article 6 is sort of the baseline, and even Article 6 had some requirements around the regulation of you have to still kind of talk about how you deal with sustainability risk, even if you choose to be Article 6. So there is still some information coming out about these funds, even if they didn't choose Article 8 or 9. So that's how we interpret the positive coefficient here. And then 1 globe funds generally experience outflows if they didn't choose Article 8 or 9, which also kind of makes sense if investors value greenness. Okay. So moving on to the role of preferences, we then add this interaction with environmental preferences to the regression. So remember, that's taken from the survey. So it's basically what percentage of people in the country say they care about the environment. And we find that in those countries, so there's a positive relationship between environmental preferences and flows to those uncertainty shock funds. So funds with a missing globe that chose Article 8 and 9 experience flows specifically from investors with higher environmental preferences. And even more strongly, they respond to the greenish channel. So those funds with 1 globe who then chose Article 8 and 9 experience very strong inflows from investors in countries with stronger environmental preferences. And one thing that's nice about our data that I should highlight, and this is sort of like a more general point about the mutual fund literature, is that generally in mutual fund papers, everything is at the fund level. So you can't do any within fund analysis. But here, what's nice about our data is that we can include fund fixed effects in these last 2 columns. So what that means is that we're thinking about within a fund, which investors are most responsive to the regulation. So that's sort of an interesting angle because it allows us to sort of separate the effects that are driving the funds anything that's driving the fund level variation, and then to dig down and see which investors are actually responding to the regulation. And that's again where our data is really nice to see, because we don't have to be concerned that the decision to regulate was then related to the preferences in that country, because this regulation applies uniformly across the 24 countries in our sample. So then we're looking at institutional versus retail investors. So there's like a few different hypotheses you could have come up with ex ante in terms of institutional investors. So one is that retail investors are less able to navigate sort of the uncertainty landscape. So you might think that the uncertainty channel should be stronger for them. That's actually not what we find. And that's more consistent with the interpretation that retail investors, or institutional investors, sorry, are more risk averse with respect to greenness. So for example, an institutional investor might be worried about investing in a brown firm or a brown fund because they're worried about some sort of reputational risk in the future, like if there's an oil spill or some pollution scandal or something like that. So the institutional investors care a lot about making sure that there's no sort of downside greenness risk in their portfolios. So that is what we find, that the institutional investors are within a country are most responsive to both the greenness shock and the uncertainty shock. And then finally, I didn't have this here, but we also had a table in the paper that I should have had in the slides that interacts that with preferences. So we find that within a country, it's also that institutional investors in a country with stronger preferences are respond more strongly than institutional investors in a country with weaker preferences. But even for households, it's still the case that in countries with stronger preferences, the households are also more responsive. Sorry, I'm not sure where that table went. So I'm a little bit early, but to conclude, we look at how ESG disclosure regulation for mutual funds affects the asset allocation of both investors and funds. We use a unique experiment and new data to shed light on the question. Our main findings is that in our model, we found that there was 2 channels for ESG disclosure to transmit to portfolios, an uncertainty and a greenness channel, and we find empirical evidence for both of these channels. We also find that there's strong flows to green funds after the regulation across all investors, and then the regression suggests evidence for both the greenness and uncertainty channels. I'm happy to take questions now.
Thank you so much, Joanna. It was a really fascinating talk on a really important topic. So I will open the floor after I've asked 1 or 2 questions myself for questions from the audience. So to the audience, if you would like me to read out your question, please post it in the Q&A window. You find the function at the bottom of your Zoom window. And if you would like to speak up yourself, please use the raise hand function after posting your question so I can unmute you. So I guess, Joanna, I have 2 questions for you. The first one is, given your study and what you've learned from your study, do you think that the EU experiment, I guess, to introduce this ESG disclosure regulation is beneficial and should be replicated in other jurisdictions? Because, you know, you find that you get more inflows into green funds, both because of the reduced uncertainty and sort of the preference for green assets. So in principle, it could, you know, help a little bit with enhancing the flows of finance for the green transition. So anyway, keen to hear your thoughts on that.
Yeah, so I have a few thoughts. One is that our paper, at least the model that we have, like for simplicity, we kind of fixed returns and looked at just the flows based on the uncertainty and the greenness. One way that this could make a big difference, like a negative difference, is returns. Even if everything kind of works exactly as the policymakers are supposed to, if there's a kind of fixed supply of green assets and you get all these flows into the green funds who have to buy the green assets, you're going to have lower expected returns. We haven't touched that in the paper. In the appendix, we have a version of the model which shows that there's like this return channel that is offsetting the greenness in the uncertainty channel. In another thing that could happen is fees, and we're like about to do a version of the regressions where we're looking at fees and do these Article 8 and 9 funds charge higher fees. So that's kind of part of it, is that if investors are being charged a lot for this, is it actually, like, is that DI parameter strong enough that it offsets the increase in fees? So that's one other thing. The other thing that you said is about financing the green transition. So I guess that could sort of mitigate what we've talked about. If this is sort of the flows into green funds, then make it less expensive for funds or for firms that are trying to like be greener to access capital, then it might actually increase the supply of green assets in the economy. So that's sort of the next paper that we're planning to write, is about that. Yeah, those are all really interesting questions. I think right now, everything we're doing is like kind of on the positive side of the regulation, because it's less uncertainty is always going to be positive, but there is obviously some things that happen in equilibrium that we haven't shown here.
Absolutely. And by the way, if you have those papers, please send them my way. I would be very curious to see the results. All right, so let me turn to the audience. I have a question from Dr. Mohammed Nasser, who's asking, in slide 22, during 2023, carbon intensity was dramatically increasing, although regulations approach recommended the opposite. Could you give more explanation about sources and causes, please?
So I should tell my co-author who made this paper or made this graph to put a bold line at 0. So it actually isn't dramatically increasing. It's just decreasing less. The 0 is up here. So that's one just like small technical note. The source that we use is Morningstar. So what Morningstar does is they look at the holdings of the funds, and then they take, I think there's some threshold. So they have to have coverage for like some percentage of the fund's assets, but then they look at the carbon intensity of the firms that the funds are holding. So the variation, this could come from two sources. One is the fund's portfolio stays exactly the same and the firms themselves become greener. The other one is that the funds move their assets into greener funds. So this sort of mixes up the two. We have reconstructed this variable by ourselves using the FactSet holdings data, and we find that it's more the second one. So the funds are moving their assets into greener firms rather than fixing their portfolios and having the firms themselves become greener. But generally, there wasn't actually a big increase. This is kind of a misleading graph when you look at it for a second. It's just the major decrease, the largest decrease happened right after the enactment of the regulation.
Yeah, got it. Thank you so much. Actually, if you don't mind, I have a second question for you, which is when firms declare that they want to be classified as Article 8 or 9, does the EU actually, the EU regulation, check whether they should be allowed to be qualified for that? Maybe you explain this, but then I might have missed it. And then relatedly, you showed on one of the pages an graph with the difference between the ESG scoring of dark green, light green, and brown firms. So is that ESG score like who's doing that scoring? And I guess moreover, what does that ESG score take into account? Because if you actually would want to, in the next paper, right, study the quote unquote real effects of increased flows into green funds, then you would want to know ultimately what that actually means, that there's more flows going into there, and like, are they actually, like, on what basis are they deemed more green, and what difference does that make?
Yeah.
So those are really two parts of one question.
So this graph, the data is from Morningstar. So what Morningstar does is they have this corporate sustainability score for the portfolio. So they look at, I actually think they take it from one of the data providers like MSCI. And then so they have the ESG score of all the firms in the portfolio, and then they take quintiles of it to get the globe. So 5 globes is the top 20% within that funds category, so like equity funds, of this like corporate sustainability score. So I should look more into like exactly what that is measuring and how it aligns with.
Yeah, and also, I mean, of course, ESG score is different than E-score, right? So in some sense, this darker green, depending on how it's measured, be also higher S or G. So it would be really interesting to know exactly what the basis is of this.
Yeah.
ranking.
One thing I will say about that is that in the SFDR, there actually are some of the objectives that can be related to diversity and other of the more like S or G categories. So it does sort of align. One thing I wanted to show you is I had in the appendix of the slides that I didn't show. These are kind of some examples of what the funds actually have to do. So this is an Article 8 fund, and they are going to, it says pre-investment, the following principal adverse impacts on sustainability factors are considered. So they're going to look at exposure to the companies active in the fossil fuel sector, violations of the UN Compact principles, an organization for this long thing, activities negatively affecting biodiversity, exposure to controversial weapons. And then post-investment, they're going to engage with the fund, so via voting. So that's for Article 8. So this is what it means to like consider sustainability in your investment strategy. And then Article 9, so this Article 9 fund adds a specific sustainable investment objective. So they say they aim to support the sustainable use of natural resources and ecosystem services, as well as technologies, products, and services that help to reduce biodiversity threats or restore natural habitats. So they have a specific objective where they're aiming to support funds that are, or firms that are doing this. And then the other thing I wanted to say is that how do they verify this? So the funds, especially after level 2, have to submit these reports to I'm blanking on the name of the regulator, but they have to submit a form that has this to the regulator. And then one thing that is sort of like could affect our identification strategy, I guess, is that the enforcement is then at the country level. So the countries can decide how strictly to enforce this based on the country of issuance. But in all of our analysis, we have country of issuance fixed effects, so like it shouldn't be as much of a problem, but the individual countries are then responsible for enforcement. So they can fine the funds if they think that they haven't actively done this.
I see. So and can they also exclude them and say, you self-declared as, an Article 9 fund, but really you shouldn't be in here because you're not.
Yeah. So in order to be Article 9, like there's a list of things that you have to do, like what I showed you, and they can, if you don't like live up to that, and the funds also have to post this on their website, so the investors, if they are interested, would then know that they're not doing it accurately. So I think funds have an incentive to tell the truth about this, because there's like big reputational costs to lying about it, and then you have to put on your website something that's not true. One other thing I should say is that you have to align with one of these environmental objectives. So biodiversity, like I showed you, is one of them, but you also have to not be harming any of the other ones. So you can't be a company that only hires male employees and then also is pro biodiversity. So you have to be not actively harming any of the other objectives.
And then they can also get fines, right? If they're not doing.
Yeah.
Okay, that's really interesting. Thank you so much for those clarifying questions or answers. Let me now turn to Olympia. Olympia, would you like to unmute?
Thank you. Sure. So I had a couple of questions. So first of all, thanks a lot for the interesting presentation. I was thinking first that you mentioned this a little bit in the model while reading the paper, so that, but not in the empirical part. So I was wondering, given the introduction of this regulation, I would expect that fund fees would also kind of play some role related to the flows. And so I was wondering, how do you think about that? If you can observe something in the empirical setting, in the empirical analysis, and what do you think could be the role of this, considering that it might be more expensive, more costly to come up with ESG related investment policies to incorporate them, but at the same time, like the competition in this market for ESG funds could change. So
Yeah. So you're exactly right. We had this fee parameter sort of snuck in here. In our empirical stuff, we've downloaded all the fees data. So we're going to do that like in the next couple of days, is my impression, to understand how fees themselves move. The other thing is what this would do if the funds could choose their fees is you basically have to know how elastic the investors are. So it basically would be like changing this like mu r parameter. So instead of just changing sigma g and g, the model would also change. I mean, it's not mu r because it's the fees, not the actual returns of the portfolio, but the idea would be that the investors are then going to respond to that. So everything that we've showed you in the empirics is sort of like the equilibrium outcome given any changes in fees going on in the background. So if we see that there's a lot of inflows into Article 8 and 9, and you think that the Article 8 and 9 funds would increase their fees to sort of support their sustainability, then that would sort of, if that were the case, it would bias our results downwards. So like anything this is sort of like a lower bound for the like net of fees and returns result that we would want to have eventually.
Thanks a lot.
Thank you. That's super clear. Are there any other questions from the audience? If so, please raise your hand or put it in the chat. All right, I think that's it. Well, thank you so much, Joanna. I really like your paper, and I'm really excited.
Alyssa,
Yes.
I'm sorry, there are two questions in the Q&A
Oh,
function.
sorry. I might have missed it too. Do you mind reading it? Because for some reason I think let me see,
Yes.
everyone. Let me see if I somehow missed, I can't see it, I think.
Oh,
All
yeah.
right, so let me read them then. There was one question by Andreas Breitenfelder, and it's he basically says that the presentation was a little bit too quick for him, and he wants to know what are Globe 1 or 5 funds.
Sorry about that. I should have clarified that. So One Globe funds are the bottom 20% of funds by the Morningstar rating. So it's the brownest 20% of funds. So they're going to hold things like fossil fuels. There's also some data points related to defense, that kind of thing. The 5 Globe funds are the top 20% of the sustainability rating. So they're going to hold things like green energy companies. And there's some debate that they're also holding things like healthcare, things that sort of are apart from the green transition debate. So you can think of them as low emission or sustainable firms.
And sorry.
Oh, I was seeing the next question, but you can read it.
Oh, okay. So the other question is from Celeste Hardy, and she asks, which specific data point from Morningstar do you use to determine the SFDR classification? Do you use a time-varying data point or a fixed classification?
So the answer is both. The way that Morningstar reports it is in around 2021 when it first started, they had one static data point that they didn't update. So we have initially used that. So every fund, if a fund was Article 8, they were Article 8 forever. Now, since 2022, Morningstar has also added a time varying SFDR classification. So we've started to use that. For example, here, this is all using the time varying. Anything past 2022 is time varying. And then the coverage is different. So we kind of combine them. We've combined them in a bunch of different ways to make sure that it's reasonable, but anything before 2022, we're using the static one. After 2022, we're using the dynamic one where it's available. And if not, when it's not available, for funds where it's not available, we use the static. And then when it's not available at some points in the time series, we like fill using the most recent one or something like that. So we're trying to filling in a time series for each fund using both of the static and the dynamic. And the one thing I will say is that like revisions aren't like super common. So despite all the sort of news coverage that, the level 2 is going to make all the funds downgrade and everything, especially downgrades between 8 and 9 to 6 are very uncommon. There's some downgrades from 9 to 8, but it's very rare to go from 8 or 9 to 6 in the time series Morningstar data.
All right, so Anastasia, I think we've covered all the questions. So I want to thank Joanna again for her really interesting presentation, and it sounds like interesting research agenda that I'd love to follow. Our next webinar will take place on April 14th. This will be an e-access forum webinar, not a Young Scholars webinar, and it will be a panel discussion with central bankers from the Bank of International Settlements, the Central Bank of Chile, and the Danish central banks on how central banks should address climate change related inflation. The link to this webinar will be found on the website where you can sign up for this webinar as well as for future events. So with this, I want to thank also the audience and thank the speaker again and the organizers, and see you next time. Bye.